Welcome everybody to the non-inaugural, probably sixth Texas Multifamily Investor Meetup. For those of you that don't know, basically, we're part of MFM, Multifamily Masters, a group that we help run. And essentially what we did, what was it, 3-4 months ago? Decided to basically combine the two different chapters in Texas that we have. Ben and I run the Houston chapter, and kind of our partners run the Dallas chapter. And we figured, hey, there's way too much online stuff going on. How about we combine rather than everyone doing their own thing? So we're doing basically a virtual in-person meetups for, we'll see for how much longer, right? Probably definitely through the end of the year, and we'll see kind of what COVID looks like. We're all definitely hoping to bring it back to the in-person meetups here soon. I know we, huge success kind of doing that, and so we'll do that hopefully in the next 6-8 months, and we'll kind of see what the world looks like. But for those of you who don't know me, my name is Faris Musa. I have a company called Disrupt Equity along with my partner, Ben. I'll have him introduce himself shortly. And for today's episode of our Multifamily Investor Network, we decided rather than bringing in, other speakers like we've been doing, right, we figured, hey, it'd be good for people to kind of really have the leadership just introduce themselves, right, and start to do maybe 2 series of roundtables, right, where each person kind of share a little bit about their background. Each person's very different, and then really let the audience ask questions, right? These guys have done all sorts of different things. I think from my perspective, right, usually the most valuable part is doing Q&A questions and, asking the things that you all care about. So, with that said, I think today, really the structure for today is going to be different than previous ones, right? We'll do a little bit of a roundtable, a little bit of moderating, but kind of open it up to question and answer at the end, right? And really the goal is kind of about 45 minutes of that, and then we'll do 15-20 minutes of breakouts after that. And so for those that have never joined, a breakout is basically where we'll split the audience. We'll see, usually we get about 80, 100 people. So we'll split the audience into groups of, 5, 6, 7 people, and you can kind of have a little bit more of a smaller conversation, right? This whole, multifamily is all about networking, all about the people and so, we're big supporters of that philosophy, and we want to help facilitate that, right? You never know who you might meet. I mean, for those of you that do know, I met my partner, Ben, at a meetup, so, you never know who you might meet, and I think, networking is a very important part of this business. So with that said, I guess enough about me. I know I tend to talk a lot. I will let Ben introduce himself, and he talks even more than me for those of you that know him. So Ben, you want to go ahead and quickly introduce yourself? Just really quickly, just introduce the leadership, and then we'll actually kick off the round table. So don't do the deep dive.
All right. So, okay. Well, I'm Ben Suttles. I'll try to keep it to 15, 20 seconds. I'm the other co-partner in Disrupt Equity. Started this meetup 5 years ago. Like Faris said, we met through this meetup. This stuff works. Keep coming out to stuff like this. Obviously, when we have in-person ones, it's even better because this is a big relationship business. This is how people are getting deals done. This is how you, meet investors. And, I'm a big proponent of networking and doing this type of stuff. So we'll get into my background later on, but, we appreciate you guys coming, spending an hour or so with us.
All right. Thank you, Ben. So let's go hop on over to our Dallas friends and partners. Let's see, John Monteiro, you want to go first?
Sure. Hello, everyone. John Monteiro, based here in Frisco, Texas, just a northern suburb of Dallas. I have been in the area for 11 years, full-time real estate professional. I'll get into my details here in a little bit, but focused primarily on multifamily, like I think most of us do, 3,100 doors under management with other co-GPs and investors, all in Texas. I am solely invested in Texas and plan on keeping it that way for many years to come.
Our Hawaiian friend is pro-Texas. I love it.
That's right.
Yeah. It's the best state to be in. Georgia's great too, but we'll let that slide, John. So, all right, let's see. So Anton, you're up. You want to go next?
Sure. Hi, everyone. Anton Madley, co-founder and CEO of Peak Financing, based here in Dallas. I live pretty close to John, also in Frisco, Texas. And we arrange financing for commercial real estate, including multifamily. We have loan advisors across the country, a number of people here in Dallas. And so that's what we do on a day-to-day basis. That strange accent is from Switzerland. I live in Texas for 15 years, but I was born in Switzerland.
All
Let
right.
that fly too, man.
And Anton usually has a pretty cool background of his hometown in Switzerland, but you know, Anton, one of these episodes, Anton will give a free gift to Switzerland that he'll give the tour of to that town at some point. But so for those of you that are coming on, stay tuned.
Post-COVID.
All right, and let's see.
So is that better?
Yes.
There you go. There you go. So that is Switzerland for those that have never seen it. All right, and let's see. So then I think I don't see Neil on. So Ronny, last but not least, you want to go ahead and introduce yourself?
Sure. Ronny Philip with Kingly Acquisitions. We're a commercial real estate investment firm. We focus on value-add multifamily in Texas and Georgia, and 572 units across Texas and Georgia. So appreciate everyone being on.
All right, thank you, Ronny. So just to recap, Ben and I help run the Houston chapter. John, Anton, and Ronny help run the Dallas chapter. Hopefully next year we can do the in-person ones, and they'll be twice as awesome as the virtual ones. But for those of you kind of joining in, I know a lot of people kind of got new. For today's episode, we're going to do it different than previous ones. We're going to do a little bit of a roundtable where we deep dive with, today we're going to have John, Ronny, and Ben. And so we're kind of really do a little bit of a digging into kind of their story, where they're currently at, how they got started, and what they're looking to do. And really, for me, the goal is I'm going to facilitate, but more importantly, the goal is to let people ask questions, right? Ask all the hard questions to Ben and John. Those guys like the hard questions. Ask the fun, easy questions to Ronny. Ronny always has a good story. And so, we'll all make this a fun thing. But really, the idea is to help educate people, help us learn more about you all and learn more about our guests. And, and at the end of this, right, so we'll do that for about another, 30, 40 minutes from now for another 30, 40 minutes. And then we'll do breakout session at the very end where we'll break this room up into randomly, groups of about 6, 7 people. And maybe you'll get lucky or unlucky getting stuck with one of our guest speakers, and maybe you'll get to meet some other people. So, it depends kind of what you're looking for. So with that said, let's see, which one of you three is going to go first? Let me flip my 3-sided coin. All right, Ben, you're up.
Well, no, everybody. Like I said earlier, Ben Suttles.
Yeah, sorry, let me guide you. So really quick recap, can you share a little about yourself, where you are currently for each of you? And then I'm going to do another round and basically dig into kind of, my question is going to be to all three of you, is how you got started, right? What attracted you? What was kind of the first thing you did? And then, the third question will be, what are you guys, looking to do based on where you're at now? So those are going to be the 3 questions. I'll lay it out for you guys to think about it. Ben gets about 3 seconds to think about it. All right, Ben, you're up. Go.
All right, so I'm going to answer my current question. Where am I at right now? Co-founder of Disrupt Equity. I would say that me and Ferris are entrepreneurs first, investors second. We love, putting businesses together. We love solving hard problems and doing big things, and that has, led to different businesses, partnerships with Anton, partnership on the commercial insurance side through Strategic Insurance Group. We created our own property management company. It's called Disrupt Management. And each one of those, we're trying to solve problems for people in the industry and automate things. We both me and Ferris come from an IT background. I was in the sales and business development side. We currently have 7 assets. We've syndicated 10, sold 3, raised over $20 million in equity from investors, some of which are on this phone call or this webinar or whatever we want to call it. And, looking to learn, you always continuously learn in this business. There's always better ways of doing things. It's a very complex business, and, that's why I like hopping on these things and adding value where I can, but also, I'm a student of the business as well. So that's a little bit about where I'm at and what we're doing.
All right. So that's Ben. So really quick question. How awesome is your partner?
Oh, come on, man.
We'll let that go. All right.
He's great.
All right. John, you want to kind of same question. You mind just kind of really, kind of just do a deep dive into what you're doing now, where you're currently at, kind of whether you want to share unit count, equity raise, right? Kind of the same stuff that Ben did, and then we'll go rewind a little bit of history to kind of each of y'all's kind of how you got started.
Yeah, like I said, I'm based here in Frisco. I moved here in May of 2009 in the depths of the last recession. So here we are again. I moved here for exactly that opportunity. I figured that Texas was going to come out of this last recession well. It was a good bet. It was a great move from Hawaii to Texas. Great move for my family, my 4 daughters, and for my real estate career. I've been doing full-time real estate since investing in real estate for 20 to 25 years, for much longer, but full-time since I moved here. I was doing single family for quite some time when I first moved here, built that business, scaled it up, sold it to a local bank, and then transitioned into a land business that I currently own, where I'm buying and selling land in Texas, and then also commercial real estate, both on acquisition and repositioning of B and C class assets, but also working on some new development projects with a couple partners, one of them being Michael Lay, who's on the call tonight.
He's in his train.
He's not on the call. He's on the train. All right.
On the train. Sorry.
He's on the train on the call. All right. So for John, you're right. Just to kind of recap, right? Ben, definitely kind of in the syndication BC space, right? Existing assets. John's done a little bit of land. It sounds like a little bit of flipping, and also syndicating BC assets as well as new development, right? So that's kind of where you are today.
Yep.
All right. And so then, last but not least, Ronny, and I'm disappointed Ronny's not in his suit. The guy is in a suit 9 times out of 10. Instead,
I'm wearing my plaid.
So Ronny, same question to you. And I think you're muted, by the way. There you go. Do you mind maybe kind of quickly just recap where you are today and kind of, with the business, right? And then we can transition into, some of the other parts.
Sure. So I'll give you a quick brief background about me. Start off in residential real estate as an agent back in 2015. Transitioned into flipping houses. Realized those 2 businesses weren't scalable. So in 2017, I started Kingly Acquisitions. And then just put my head down for about a year. Met Ben and Ferris end of 2018. Started working together, and together we've acquired 572 units, and they've been great co-GP partners. And now I'm just looking to continue to scale. So that's where I'm at currently.
All right. Awesome. So Ronny, a little bit of a different phase, right? But definitely in that got his feet wet, growing phase, and that's a fun phase to be in. Sometimes it's a headache
Ronny's
to be
the
the other
king
phase.
of networking, man. He's the king of networking.
Yeah. Pre-COVID, what did you do, Ronny? Ronny was at every single networking event.
Ronny was, he was prolific, man, and great on social media too, guys. Always got a lot of good tips and tricks to kind of hack that world too. So
yeah, and maybe to read the comments, Ronny doesn't need a suit. That beard game is coming in strong. So leave it at that. All right. So then, so to kind of go through, so let's rewind in history for all 3 of you guys, right? And really maybe dig into how you got started, what attracted you to multifamily, and kind of what that first deal was. We're going to do this in a different order now, all right? Ben needs some time to think about it. John, do you want to go first?
Yeah, sure. So like I said, I've been investing personally in real estate for 20 to 25 years. I lose track of time. It's been so long. I'm the old guy in the group here.
That gray hair stashing, don't worry.
Yeah, exactly. So prior to me doing full-time real estate, I was, working corporate jobs just like a lot of other folks. I guess most notably, I was the founding management team of Walmart.com. We were the founding group of Walmart.com back in 1999, where Walmart Stores was a minority shareholder. We basically took that business when I was there from zero in revenue in 1999 to over $1 billion a year in 2005. And I tell that story because I wasn't the guy writing the code. I was the one that actually was building out all of the operations and infrastructure. So all the logistics, supply chain, carrier management, logistics, et cetera. And so I tell that story because I took a lot of those learnings with me on how to scale businesses and was able to apply that to my real estate career and my real estate businesses. And so when I got out of the single family game, I figured that in order for me to continue to scale, that commercial real estate was really the path for me. And so I took a lot of those learnings around people, process, systems, and data, and applied that to my commercial real estate career. And so over the last 6 years, like I said, I've gotten with other co-GP partners and investors 3,100 doors in DFW, San Antonio, and Houston. And I'm continuing to look for opportunities and partnerships as we move forward. My first deal was a small multifamily in Hawaii when I lived there. It was an 8-unit deal. Bought it in 2008 in the recession. Got a really good cost basis on it. Fixed it up, leased it up, and did 2 refinances during my hold time, and basically pulled out all of my capital, and basically was able to kind of create infinite returns after being able to refinance that property twice.
Having visited Hawaii, I learned that every house is a multifamily for the most part.
Yes,
They're very good at kind of, living together. But I wanted to deep dive a little bit though on how did you come across multifamily, right? What was that first spark, right? Was it that you read a book, you knew a friend, what was it that kind of led you down that path before you got going into it?
Yeah, I mean, I think it started with reading and podcasts and just kind of, starting to network in different multifamily circles. Most of the people that I know here on the call, I've met through networking. And so I just kind of put myself out there, joined a lot of different groups and networking events, and slowly kind of formulated what I thought was my game plan to get into multifamily. My path personally, after the small 8-unit deal in Hawaii, to get into larger deals was to become a passive first in a deal, where I was able to kind of look over the shoulder of a GP that was very generous with their time and their knowledge and their experience. From there, my next couple deals, I was a key principal in a couple deals, and then from there moved into GP and co-GP roles with other people.
Got it. But that initial start was just you, I guess, looking to want to invest in something, whether real estate or stocks or something else, and you kind of stumbled across real estate. Is that?
Yeah, I mean, I knew it was going to be real estate. I was looking for something where I could scale. Doing 100 single family homes a year is just so much brain damage. Much easier to manage, 100
Yeah, the
people
flippers look at us and
roof.
think what we're doing is hard, and I look at them, I'm like, man, what you guys are doing is harder. So I feel you on that one. No, but I mean, I think very similar story for me even, right? I think learning for anyone there that was watching, right? Learning what differentiates from maybe what your career was before, applying to real estate is a really good way to get a one-up, right? That is kind of some of the secret sauce that the guys that have been in real estate for 30 years maybe aren't doing, right? You can kind of really get economies of scale or efficiencies. All right. So Ronny, let's kind of move on over to you. Same question. So maybe, what led you down that real estate career or that start, right? What attracted you to it, and what made you, in your story, right? What made you transition to multifamily away from kind of real estate?
Yeah, great question. So I think my initial spark was my high school business teacher read a book called Rich Dad, Poor Dad. And what really struck out to me was Arnold Schwarzenegger's story on how he scaled to like 10,000 units. So I was like, okay, my plan was go to college, become a doctor, save up money, buy apartments. And I wanted to own 300 units. That was my goal. And that was the initial spark for me. And then how did I get into multifamily? So I went to college for 3.5 years, bio major. Then I realized I was really not good at biology and math, and excelled in pretty much everything else. And had different jobs in college, selling home phones at Indian grocery stores for a company called Vonage. So that was like a pretty interesting job. Then I transitioned to a pharmacy. So I was a pharmacy technician, counting pills, all that kind of stuff. And then And then I got really tired of being in pharmacy. I saw the job outlook wasn't going to be good in 2020 when I would have graduated pharmacy school, what was it, 2020. And I was exactly right. So I dropped out of college back in 2015. So I was 21, 26 now, and got my real estate license, started off as an agent, helping people buy and sell homes, then into flipping houses with my dad. He wanted to get into that business. He flipped one house, so started sourcing deals. He would buy it. I would construction manage, all that. And I got really tired of that too. I mean, that was really exhausting, helping him manage his single family rentals and whatnot. And I realized those two businesses weren't scalable and they don't really have enterprise value when you go and sell it. So 2017, I started Kingly Acquisitions, and then, y'all know the story from there. And then as far as my first deal, 212 units in Atlanta, and I partnered with Ben and Ferris on that one. That I closed that one with y'all March 2019.
All right. So the story for Ronny is, don't make him tired, right? He gets tired, find something better to do. So, I had another thought and I totally lost it.
Killing me, man. You're killing me.
So at least with Ronny, with your story, right? I mean, you did have exposure through your family, right? That was a little bit of the, kind of getting a sense to what real estate is and kind of what things are possible or not possible, right? Would you say kind of without that, do you think you would have gotten into real estate?
Yeah, I would have got into it without that as well. I mean, it was really just like, I think the biggest spark was reading Rich Dad Poor Dad. And then I started listening to podcasts and eventually going to conferences and meetups. But I think that was my initial spark.
Got it. All right, perfect. And then Ben, you're up next.
All right, I forgot the question, man. What are we talking about? I'm just joking.
Anything you want to talk about?
No. I mean, kind of how we got it. It's a similar story, right? Rich Dad Poor Dad was really the inspirational book that kind of got me into real estate, right? I mean, I think I always tell people it's kind of light on how to do real estate and big on kind of that mindset shift. And so it was kind of a light bulb moment for me. And, and I know Amanda's on, so we're Robert Kiyosaki, training, alumni. So I went down that route and spent a ton of money kind of learning the single family world. Did some wholesaling, did a couple flips, but ultimately, like everybody probably knows, it becomes kind of brain damage quite quickly. And, the money that I was making, right, just wasn't worth it for me to, really kind of lose any more of my hair at the time, and so I know I don't have any left anyway, but and
you didn't, whenever we kicked off, you didn't really have much.
This was 7 years ago. All right. I had plenty of hair on my head, but I mean, so single family for me, it was a lot of brain damage, but we do obviously know a lot of people that can make or have made money and do make money on it. But for me, it was the scalability or lack thereof that I didn't like. And, so I started kind of seeking out other things that were a little bit more in line with what I was looking for. And I found multifamily. I was originally, kind of drawn into it by Del Walmsley, who's the owner of Lifestyles Unlimited. Ultimately kind of stepped back because I'd already spent a lot of money with Robert Kiyosaki, put my wallet back in my in my pants and slept on it. And, but then about 6 months later, came across Brad Sumrock. He was speaking at an event here in Houston, went down that route, learned a lot, met a lot of great people, some of which are on this call tonight. Ultimately did my first deal there and was off to the races after that. So, but yeah, once I found out the power of commercial real estate and all the tax advantages and the scalability of the whole thing, and because I come from a sales and business development background in the IT world, and networking, going to conferences, speaking, all of that was just kind of second nature. And really, the syndication side of the business really spoke to me because it allowed me to kind of bring that skill set into commercial real estate. And so it was kind of an easy segue. It's a different product, right? You're selling, an investment opportunity to investors versus some kind of an IT product. So that's kind of a little bit about my journey and kind of where I kind of stumbled into multifamily, I guess I'd say. but
All right.
haven't looked back since.
All right. Well, then let's yin-yang it back. So that's how you got started. We heard earlier where you're at now. What's the 5-year goal? Actually, what's the 2-year goal? What's the 5-year goal for each of you? And so, Ben, let's just kind of continue down, I guess, your story.
Well, I think as everybody kind of knows, we had to kind of burn down 2020. So all of our 2020 goals, for the most part, in terms of acquisitions, are going to be now 2021. So my expectation is that, if the opportunity presents itself, we're going to buy 2,000 units. Continue to build out these other businesses that we partnered on and, went out to create. And so that's going to be, my next 2-year goal. 5 years out, I'd love to be sitting on 10,000 units, on the acquisition side, assets under management, as well as 10,000 units under third-party property management as well. So that's kind of, my internal goal over the next 2 and 5 years. And, I always tell people, right, put hairy, audacious goals up, right? People surprise themselves at how close they actually get. And instead of just, putting the goal out there that that you can achieve, put the goal out there that you're just, in your wildest dreams, you're never going to be able to hit, right? And you surprise yourself how close you get to that, and I also want to tell people, right, just keep at it. I know there's some folks on here that are still looking for deals or maybe just getting into this business. This is not an overnight success thing. I always tell people you can get very, very wealthy, but it's not this is not a get rich quick scheme. You have to stick with it. I've been doing real estate for 7 years. I've been doing multifamily for 5, right? I've only started seeing a certain level of success the last couple of years. So you just got to grind it out, right? So I guess that'll be my 2 cents.
All righty. Good answers. Ronnie, same question. So kind of the 2-year goal and the 5-year goal.
Yeah, so 2-year goal would be around 2,000 or 3,000 units. Vertically integrate. So either start a property management company or buy into one, and then have construction in-house. 5-year goal would be 10,000 units, $1 billion in assets under management, and have a JV equity fund fully running.
I like it.
All right. Short and sweet. So for those maybe listening, what does a JV fund, equity fund mean? Maybe you can kind of help dig into that for people.
Yeah, so a JV equity fund, pretty much like what Blackstone does, they provide capital for sponsors like ourselves. So for example, if Ben and Ferris need, $10 million, they have a $10 million raise, a JV equity fund will provide 90%. And then they structure a split that way. And I feel that's a pretty cool, scalable business. And there's a lot of equity out there. So I feel like that's probably the biggest opportunity I see as far as growth in the next 5 years.
All righty. Perfect. And Mr. Monteiro, same question to you.
Yeah. Before I kind of throw out some numbers, I'll just want to say that, I think that the next 5 to 10 years in real estate is going to be another big run up like we saw over the last 10 years. I'm an economics major in MBA, and I'm constantly tracking trends and cycles and data. And, we're in this dip right now. This is a perfect opportunity with conservative and smart underwriting for you all of us to kind of lock in on really low fixed rate debt and get into good assets with good partners. And, we just hold on for the next 5 to 10 years. And based on what's going on in today's world, there's going to be another asset bubble coming our way. And so this is a perfect opportunity now in this downturn to keep looking for opportunities and jump on those deals, find your team, build your team, your partners. And then from there, if I'm able to do those things, I think that in the next 2 years, I'd like to do 3 new development deals, ground up, anywhere between 200 to 300 units each. And then on the acquisition side, probably B-class assets in Texas probably get to another, 5,000 doors, I think is a relatively achievable goal to achieve.
Got it. And what kind of development have you done, and what kind of development are you wanting to do?
Well, we're doing a couple ground ups in multifamily right now. Our deal down in Katy has a mixed use component to it, but we are always looking for good land opportunities with landowners and developers that is anchored by multifamily. And if there's a mixed use component to it, we'll look at it. But multifamily is our sweet spot, and on a go forward basis, there's going to be a continued housing demand and supply imbalance, especially here in all the major Texas markets. And so I'm very bullish on multifamily long term.
All right, perfect.
Are we?
Yeah. All right. So then, with that said, right, for people that hopped on a little late, we've done a little bit of the intros of each of these people, right? 3 very different people, different amounts of hair, different amounts of beards, they're very different people. So, with that said, right, also different skill sets, different points of their careers. To us, the most valuable part is really, in real estate, there's 2 really valuable things. A is asking people questions and learning from them, learning from their mistakes, learning from their successes, right? And then the second thing is really networking. So for the remainder of this session, right, the next 30 minutes, we're going to do about another 15 minutes Q&A. So if people have questions, go ahead and ask your questions, right? These guys, I know all 3 of them very well. They're great friends, and they're all pretty transparent guys, right? They're happy to answer most questions. So ask questions. This is your chance to get to, really ask questions and learn from them, right? What's gone good and what's gone bad. I'll help facilitate. And then, the last 15 minutes, we'll do a breakout session, right? So kind of at about 8:20 Central, we'll do about a 10, 15-minute breakout session where we'll split up the room into basically groups of 6, 7 people. So with that said, I know there's one question. If you guys have questions, go ahead and ask them, right? And we'll go ahead and facilitate them. So I know one question is directed at you, John. What is your thoughts on a dip in 2021?
It's definitely market specific. I'm sure we've got people from all over the country, but it's like we're living in a little bit of a bubble here in Texas as it relates to COVID. It's business as usual. The roads are crowded. People are back to work. Yes, unemployment is still on the high end here in the major metro areas in Texas, but we haven't seen a huge dip in rent or in occupancy for really good assets. We've seen a couple in the lower class, lower end neighborhoods that are showing a little bit of stress with some of the demographics that are in those apartments. But for the most part, we haven't really seen a major impact to NOI or to collections or to occupancy. So I think we just got to be careful, be cautious, don't overpay for an asset in 2021. I don't think you're going to see a ton of distress in the multifamily market here in Dallas, Houston, or San Antonio, but every once in a while you'll find a deal. So,
got it. And maybe on a similar vein, maybe I'll ask Ben. I mean, obviously, kind of management in house. What have you been seeing in terms of dips or no dips in collections right across the different markets? That's kind of the question I'll ask you. Just add a little more to what John was saying.
Yeah, no, and John's right? I mean, in Class C deals, you're going to see a little bit of distress, right? Until I think the administration and Congress kind of get their act together, right? Whoever happens to win, in November, obviously that will kind of change the trajectory of whatever happens in terms of stimulus. But I think people probably do need a little bit of help in that demographic. Some of them are going to be in those restaurants, bars, kind of service, retail industry. And some of those folks are not, they don't have jobs to go back to. I saw something, I don't know if it's true or not, but Yelp was, kind of putting, something out there that I think 40% of, some of the companies that used to be open pre-COVID are never coming back. And that's going to be a lot of where some of these people, some of these tenants are going to have worked. Right now, ultimately, we create other jobs. That's how the economy works, but that takes time, right? I think being in where we're at, which is Texas market as well as Atlanta, which is very, very diversified economy, I feel better about it. But I'm still being cautious when it comes to our Class C assets, right? Because you have to just be aware that they are under a certain level of distress, and that just takes some maneuvering. They're pinching us from both sides because obviously with eviction moratoriums, it's hard for us to, even if it's not even COVID related, you can't evict some of these people in some of these markets. San Antonio being very, very tricky, just because the court system is just not really taking on new evictions. So you just have to kind of and that's going to, obviously, the reason I bring that up is that's always going to play into collection numbers as well, right? So.
All right, so let's keep going then. Sebastian asks, how and or who do you use for a market analysis to determine new developments are viable and have a good chance of success? John, do you do the finger to the wind approach, or do you do something more in depth? I know Ben likes the finger to the wind approach, but how about yourself?
Well, if I will first start with kind of an investment thesis. Our investment thesis is not the right one or the only one, but we don't focus a lot on infill projects. We like path of progress markets. So, markets that are showing growth where the population and jobs are kind of growing towards. That's what we start in an investment thesis. And then from there, if we find a piece of property, we will commission or order a market study, a third-party market study, to kind of show the supply and the demand, what's going on specifically in that sub-market. And if the market study comes back showing that there is a demand for the product that we're looking to build, then we'll go ahead and continue our due diligence around, I always say de-risking the deal, which is de-risking the entitlement risk, the financing risk, and then ultimately the execution and exit risk.
Got it. And I think the question is who. Do you happen to know of a firm that you use? Yeah, off the top of your mind, or maybe you don't remember one.
CBRE is a good firm. We've used multiple times. What is it? BBJ, BBR. I don't remember. I can look it up and let the group know. But yeah, CBRE is a good firm.
Yeah. All right. Good. All right. So another question. I'm just going to ask it, and any of you guys can answer. Do you recommend looking at other markets outside of Texas? If so, which states?
Ronnie, go for it, buddy.
I really like Atlanta, Georgia. It feels similar to Dallas, maybe 2 or 3 years behind. So outside of Texas, that's probably my favorite market.
Yeah, we like obviously we invest and love Atlanta. There's a couple other markets that, Phoenix being one of them. Research Triangle, North Carolina, we like. There's certain markets like Tampa. I liked Orlando up until COVID, obviously, with Disney having some challenges, that makes me kind of pull back a little bit on Orlando. But there's a lot of good things that are happening in Florida. There's a ton of population growth. A lot of jobs are moving down there. A lot of population growth is moving down there. So, we like Florida as well. So those are, obviously pretty typical markets that a lot of people look in. But there's a reason why.
Fortunately, the mouse never got the vaccine, so not invincible to COVID. All right, let's keep going. And maybe actually a question I'm going to add to that too, though. Whenever you guys look for a market outside of your markets, right, what are you looking for in a market? Is maybe to me, just as important of a question.
Good, John.
I'm like a broken record. I don't invest outside of Texas, so it's a pretty small box.
I really hope every time you go back to Hawaii, you're going back in a 10-gallon hat and cowboy boots, man.
Not quite. Mine's a very small box, just to keep it simple. Yeah, I can make, anybody can make money in Phoenix or Jacksonville, Orlando, Nashville, etc. But I know that there's plenty of opportunity here. So my box.
Why do you like Texas though? maybe that's a better question.
I think the fundamentals are around population and job growth. I saw it when I moved here in 2009. It's continued over the last decade. It's going to continue post-COVID. If it already isn't happening, it's going to accelerate because of COVID. I think people are leaving the coasts, and companies are doing the same thing. So, the basic fundamentals of supply and demand, population and job growth. And you can say that about a lot of markets in this country, but again, I want to focus on what I know, which is the primary markets here in Texas. So.
Yeah.
All right, we'll leave it at that then. Let's keep going.
Yeah, I mean, and I'd add right there, right, because me and Ferris are here in Texas as well, right? We were looking for markets that kind of mimicked what was happening in Texas, right? But between population and job growth, diversification of the economy, landlord friendly, tax friendly, all the stuff that everybody kind of talks about. That the reason that everybody keeps drilling that into everybody's head is because that drives demand for rental units. Right. And the more demand that you have, the more rent you can charge. Right. So this is all kind of economic stuff. But you really need to kind of follow those trends. And I would not go against that. There's a reason why people are moving away from Detroit, and no offense to anybody that's from Detroit. It's just, it goes against the population. Right? The trend there is going against what you would see in some of these other markets that we would look at.
Yeah, absolutely. And maybe one interesting thing for people that don't know. So Georgia, right, taxes are done at 40% of appraisal, which is awesome. But just know if you sell an asset, there is a tax that most people don't seem to really know about that you have to pay the state. And you should pay it really quickly so it doesn't roll into the next year. Ask us how we know, but
Georgia withholding tax.
So if you're ever selling an asset in Georgia, come talk to us and we'll kind of give you some direction. So you can kind of get all the I's crossed. All the I's dotted.
They're going to get their pound of flesh one way or the other. That's how they all are.
Let's see. Let's keep going then. So how much of the collections is being covered through various support programs, specifically in B class?
B class. Okay. John, you want to start off, man?
I don't have any hard data. I would definitely say that anecdotally, there's definitely been a lot of assistance, obviously, coming from the CARES Act and from the unemployment benefits that have kind of propped up the rents. People during the lockdown were really spending money on two things: food and shelter. And so we really didn't see a lot of impact to that. But I would guess that a significant portion of that rent was coming from some sort of external support, either in unemployment or the CARES Act or, other tax, IRS, rebates, et cetera. Since it's run out, we haven't really seen too much of a dip. I think, that was countered by the markets and companies kind of opening up, so people getting back to work. But it's going to be interesting to see, what's going to happen through the rest of the year and in Q1 of 2021 to see whether or not another package gets passed or not, and what the impact is going to be, because there are still obviously people out of work.
Yeah, and maybe just add a little bit to that too, right? Take the CARES Act out of it, right? There are a lot of charity groups out there that are helping with rent, and a good management company is helping capture those. I know Disrupt Management, the team has spent a lot of time really looking at the different markets that we are in and helping find all the charities, helping tenants apply. And, the more you can help your tenants succeed, obviously, the more you succeed. So it's a win-win situation. And I'd say 5% probably, is kind of
5 to 10 is how I was going to answer.
Yeah.
No.
So, all right. Let's keep going then. So I know we're getting a lot of questions. So maybe I'm going to start to do a little bit of a fire round because I know I said at 8:20. So we'll do 5 more minutes of questions and let's get these answered quickly. So Chad, how's it going? Long time no see. But his question is, how's underwriting changed because of COVID? Most existing deals are still conservatively, rightfully holding distributions due to what Ben just said.
So, okay, there's that 2 different questions. All right. So, bottom line, you've got to underwrite to little to no rent growth, right, over the next 12 to 18 months. It's just, that's where we're at, and really 2020 you're not going to be very, very aggressive right now either. So you assume that you already kind of missed out on pretty much a whole year of rent growth. You're probably talking about, like I said, little to no, unless there's just a really good story behind why they're maybe under market. If everybody's still charging 800 and you're buying a deal that's at 600, right, and they're still at 95 plus occupancy, then you might have a clear path to getting up there, right? But just this kind of traditional where everybody kind of underwrote to 2 to 3%, and we're just going to get that 5 to 10% pop at the beginning. I think that's a hard sell right now. So I think that's kind of where we're trying to be even more conservative, as far as underwriting goes.
All right, let's keep going then. So next question, current values are based on current T12. Do you believe by April 2021 with lower T12, we see much lower prices? T12s are lagging indicators. I'm going to answer that one really quickly. I think values are based more on actually T3s lately, or even T1s, I see people argue. So they're not as much of a lagging indicator as you may kind of think, is maybe my answer to that one.
And I don't think because interest rates are where they're at, I don't think we're going to see this big dip in asset values. I was more bearish 3 or 4 months ago, but we just have not seen that. And John kind of alluded to this too, right? Maybe you see some opportunities, but because of where debt is, that's going to prop up asset values, right? Unless you just have a tremendous drop in collections, then all bets are off, right? But if everything kind of maintains where it's kind of been, and there's a fair amount of equity that's sitting on the sidelines too, and I think they're just waiting until the election's done. So I think that's going to also beef up asset values.
All right, let's keep going. Let's fire around these. So let's try to keep answers 10 seconds apiece. So what are your thoughts on San Antonio as an investment for multifamily with its proximity to Austin? Somebody.
Ronnie.
And maybe Ben, you're the only one in San Antonio. Actually, yeah, you too,
Ronnie's partnered with us. All right, what do you got, buddy?
Yeah, so I think San Antonio is what I call a sleeper market. A lot of people don't really know how good San Antonio is. It's not as forgiving as Dallas. I think occupancies are lower in San Antonio overall, and you have to buy in the right pockets, but I think there's good basis there and there's good cash flow. And I think, like the deal we bought in San Antonio, I think we got it at a great price and we have great value add plan. And I think if we get it at a good basis, it'll be good. But I have seen San Antonio prices skyrocket from last year to this year. So it'll be interesting to see how that trends up.
All right, let's keep going then. So Hamad says from Detroit, not touching it. All right, good answer. Let's keep going then. Let's see. So had a mixed use opportunity in Orlando cross my radar recently. Good to know, not to be too excited about it. But if there's anything interesting, feel free to share it with any of the leadership. Sure, we can help connect you with somebody, or maybe someone will be interested. How much of an impact on the Houston demographic do you see from the energy market plus COVID? I guess I'll ask Ben. You want to answer that one because you're the only one in Houston. And actually, John, you have a deal in Houston too. So
I mean, it's the same. I guess if you're in, I would say if you're in Texas, it's going to be similar in all the primary markets, right? There's a little bit of dip. There's a little bit of squeakiness amongst Class C tenants, right? But ultimately, we're opening up. I think we're a little bit ahead of the curve in terms of our economy, and I think we were kind of ripe to bounce back a little bit more quickly than some of these other places that people were just looking for an opportunity to move away. And they're moving to Texas. So some of that depression is going to also be offset by people moving here.
All right, let's keep going. But maybe just to add a little bit to that, right? Energy is a little bit like a lag. It's kind of a lagging indicator, so we'll see a little bit later. But Houston energy's been down for 3 years, so Houston's kind of been okay. Not better, not terrible.
And it's not the 80s anymore, folks. Houston is not tied as much to oil and gas as it used to be.
All right, so here's a question for John. John, get your ruler out. How many acres do you think is needed or required to develop and build a 200-unit multifamily? It's a very, very loose, but I'll let you answer that, John.
I mean, we're doing 300 units on 6.5 acres. It's tight. It's not. We don't have a lot of space. It's mid-rise type product, surface parking, but we're doing 300 units on 6.5. So I would say anywhere between 6 and 10 acres.
Yeah, for 200 units, yeah, somewhere around there. So the most dense you can kind of really get to is 30, 40 units an acre, right? But it depends, again, are you doing wraparound? Are you doing garden style? Are you doing, 4-story product or not? But yeah.
How much parking do you need to have? Do you need detention, retention, all that stuff?
All right, let's keep going then. So one more question. I'm looking to build a brand/platform for raising money and use as my thought leader platform. What systems are you using for CRM, marketing, money raising, and what are your best practices for building platform? And that'll be the last question that we ask. So maybe I'm going to ask each of you guys that. Let's see, John, you want to go first?
I'd say my primary platform is on Facebook. I've got a Facebook group, Texas Multifamily Investor Network. We've got 6,200 members. I'm posting, just value add content every day, different articles about Texas multifamily, the economy. So I get a lot of connections that way. In terms of managing my list, it's not very sophisticated. I just use MailChimp and send out kind of weekly roundup emails to my list. Again, just kind of summarizing all the different data and articles that I find over the past 7 days and kind of send that out to my group.
All right, John, we got to do a powwow in Houston sometime soon to modernize you, all right? MailChimp is like 2014, all right?
I know.
All right, let's see. Ben, you want to go next?
All right, I'll keep it quick. So we use ActiveCampaign on email blasts. We leverage social media as everybody should. It's a powerful tool. A lot of people are on it every single day. So, there's no reason why you should try to go against that tide. And it's all about, as John kind of alluded to, it's all about adding value, right? Put content out there, that helps educate people. I mean, there's a lot of misinformation out there. And I think if you can come at it from that vein where you're kind of trying to be, without any kind of expectation of something coming back to you, and you're just trying to educate people, people appreciate that and they gravitate to that. So that's what we've been doing.
All right. Any other tools to mention, or let's keep going then and let Ronnie?
Yeah, I mean, that's pretty much it.
I'm the tech guy between the two of us.
You just tell me where to get in front of the camera, man.
You got to mention Asana, Teams. There's a lot of tools out there, people. Yeah, the more you spend time and be productive, the more you can really scale your business.
This is the rapid fire round, man. I was trying to keep it.
All right. Let's see. Ronnie, next to you.
Okay, so as far as building a platform for raising money, I feel like this is my strongest skill set as a GP. So I started doing podcasts before school. So I started like in 2017. Did one show called the Ronny Philip Show that was featured on NASDAQ and Yahoo Finance. So have a show or have some sort of content you can provide for your audience. And you can start to test different things, right? Then I spun off a commercial real estate show. And then people started reaching out that way. Facebook, Instagram, LinkedIn. I think those are really good platforms as far as where I organize my database. I use a call schedule called Calendly, and then I use ActiveCampaign for all my email and CRM stuff. So I think those are pretty good. And if you have any questions on the raising money process, feel free to reach out to me.
All right. So with that said, we're going to go ahead and transition to breakout. So for those of you that have never been in one, we're basically going to break the group up into groups of 7-ish people. So hopefully you guys get to meet people that you've never met. Networking is a huge part of this. But before we do that, can each of you maybe share how someone can get in contact with you? So Ronnie, you first. You want to go?
Yeah, I'm going to drop it in the chat. So that's my info there. I got my email. Best way is to schedule a call with me on Calendly or email. And, we can connect from there.
Or fearofthebeard.com, right, Ronnie? All right. John,
I need to grab that domain.
I know you should. All right. John's left his inside of the chat. And maybe you want to say it as well for anyone that might be just listening.
Yeah, it's just John Monteiro at ymail.com. Instead of Gmail, it's ymail. And again, if you're on social media, Texas Multifamily Investor Network. Lots of good
And I highly
networking
recommend everyone joins
value.
that group. It's definitely one of the best groups. John's done a phenomenal
it's
job with
definitely
that. So
quality.
highly recommend that.
Yep.
Thank you.
All right. And Ben, you as well.
All right. So Ben at disruptequity.com is probably the best way to get in touch with me. You know, obviously like talking about this stuff. So, you know, reach out. We'll try to schedule a call. You know.
All right. So I'm going to go ahead and move us, right at the bottom of the hour. So a little late, but we're good. So we're going to do breakout room for about, I'll do it till about 42 minutes, 8:42. So we'll do about 12 minutes, 11 minutes of breakout.
Weird, man. Just do a 15. Come on. You're killing
All right.
me.
We'll round 8:45. I'll kill it at 8:45.
There you go. All right.
I want to be respectful of people's time, but, for those of you, it's going to be small groups of 6, 7 people, network. Learn about the other people. This turns into deals. This turns into relationships, hopefully lifelong. So, and if you don't know what to do, ask the person what their favorite vacation is, what their favorite coffee is, what their favorite hairstyle is, man. You guys are all creative. We can all figure out things to talk about. So with that said, I'm going to go ahead and kick it off.